Hi guys, welcome to Practical Trader.
Hope everyone is ready for increasing their wealth through stock market. If someone has not watched our previous video of introduction, you may watch that and register with a suitable broker. Building up a portfolio of shares that can generate a decent return over long term on consistent basis is what it takes to earn money from the share market. However, the reality is that investing directly in the stock market may not be everybody's cup of tea, as equity has been a volatile asset class with no guarantee of return. The only silver lining is that over longer period of time, equity has been able to deliver higher than inflation adjusted returns among all asset classes. Okay, now coming to generating wealth through stock market. This can be basically done by investing and trading. If you observe the big names in this industry, Warren Buffett, Benjamin Graham, George Soros, Rakesh Junjamwala, Orunju Veliath, etc. for different strategies. Here, Warren Buffett, Benjamin Graham, Rakesh Junjamwala prefers to go for long positions, that is, buy and hold the stocks for over a period of years, whereas George Soros looks for the trend of market and follows the trend. And Orunju Veliath prefers identifying undervalued companies and book profits at appropriate price points. Ultimately, you cannot judge a method to be superior to others. It all depends on your resources and requirements. Now we will look into how money can be made by buying shares. There are two primary ways to earn money from shares, through capital appreciation and from dividends. Earning from capital appreciation. By investing in shares, one can expect to earn through capital appreciation, that is, on the gains made on the capital when the share price rises. There is, however, no guarantee of capital appreciation. The probability of the market prices remaining lower than the buy price always exists. Earning from dividends. Apart from capital gains on shares, investors may expect income in the form of dividends. A company distributes profit to its shareholders by declaring partial or full dividends. In most cases, the company partially distributes profits and keeps the rest for other purposes such as expansion. The dividends are distributed per share. If a company decides to give Rs 100 per share and if the face value of the share is Rs 10, it is called 100% dividend. Considering buying ITC at a price of 280 in May 2017. In May 2018, its price becomes 287. In May 2019, its price becomes 300. And in May 2020, its price becomes 180. Now if we see the capital gain for first year, second year and third, it is 2.5, 7.14 and minus 35% respectively. The dividend income were 5.15 and 5.75 rupees per share for 2018 and 2019 respectively. If you observe, this is not that interesting result as for a short period, but if you had invested in 2008, it had only 50 rupees. In 2011, it became 100. In 2014, it became 200. In 2017, it became 300. So now you have two options, either go for long on booming firm with growth potential giving you decent reward, or fish for the firms which are expected to grow in next 2 to 3 years. To identify this, initially you will need to know their businesses, then you can dig into their financial statements etc. for selecting the firm. Other options are subscribing for IPOs and intraday trading. When asked to individuals about how much they want to make, they often tell I want to double the amount in a month, and this is the sole reason people say it's gambling. As when you expect a profit of 100%, at the same time you are increasing your risk levels to 100%. If you plan your risk-reward ratio properly and with some studies, you can surely gain from the market. Say you are not interested in any of this, as I told in previous video, you can just keep accumulating Nifty in dips. That alone can give you a return more than fixed deposit. In next video, we will learn more about investing. Thank you.